When you check your bank balance and see $10,000, that's not cash sitting in a vault with your name on it. It's a number in a database, a claim against the bank, a promise that if you ask for your money, they'll give it to you. But here's the thing, banks don't actually keep all that cash on hand. They keep only a small fraction. If every customer tried to withdraw their deposits at the same time, the bank wouldn't be able to meet all of the withdrawals at once. And yet the system works every single day for billions of people. How? This is called fractional reserve banking, and it's a system that's been evolving for over 300 years. By the end of this video, you'll see why the number in your banking app isn't actually cash, how banks legally print money every time they sign a loan, and the only reason the whole system doesn't collapse overnight. Let's start with what most people think happens when you deposit money. You walk into a bank with $1,000 cash, you hand it to the teller, they put it in a vault with your name on it. When you want it back, they go get it. That is not how it works. When you deposit $1,000, here's what actually happens. The bank takes your cash. They add $1,000 to your account balance as a number in their system, and then they owe you $1,000. That's it. Your bank balance is not cash. It's a claim, a redeemable promise. In accounting terms, it's a liability of the bank. They owe it to you. The cash you gave them, that becomes an asset of the bank. They can use it however they see fit as long as they can honor your claim when you ask. Now here's where it gets interesting. Most people never ask for their cash back. They just transfer their balance around, pay bills, swipe cards, send payments. The actual physical cash almost never moves. So banks realize something. We don't need to keep all of it. We can lend most of it out. As long as we keep enough on hand to cover the small percentage of people who do want cash, we're fine. That's the fractional part. They only keep a fraction in reserve. This wasn't invented by modern banks. It happened by accident. In the 1600s, goldsmiths in London had strong vaults for storing gold. People started depositing their gold with goldsmiths for safekeeping and getting a receipt in return. Those receipts became tradable. Instead of withdrawing gold to make a payment, you could just hand over the receipt. Easier, safer, more convenient. Goldsmiths noticed most of the gold just sat there. People preferred trading receipts. So goldsmiths started lending out some of the gold they were holding and charging interest. They issued more receipts than they had gold. As long as not everyone redeemed at once, it worked. That's fractional reserve banking in its earliest form. By the 1800s, this system was formalized. Banks took deposits, issued notes, made loans, kept only a fraction of cash on hand. Then the system went digital. Your receipt became a number on a screen, but the principle stayed the same. Now here's the part that breaks most people's brains. When a bank makes a loan, it doesn't lend out your deposit. It creates new deposit money through accounting entries. Let's use a simple example. You deposit $1,000 cash. The bank now has $1,000 in cash and owes you $1,000. Their balance sheet is, well, balanced. Then someone comes in and asks for a $900 loan to buy a laptop. The bank doesn't take your $1,000 out of the vault and give it to them. They can't. They owe that to you. Instead, they do this. They create a new account for the borrower. They add $900 to that account as a deposit, and they record a $900 loan as an asset on their books. The borrower now has $900 they can spend, but that money didn't come from your deposit. It was created through the loan itself. Your $1,000 deposit is still there. The borrower has $900. The total money supply just increased. Here's the key insight most people miss. Banks don't lend out deposits. Loans create deposits. When a bank approves a loan, new deposit money enters the system. This is both legal and normal. It's how most money in modern economies gets created. Now you might be thinking, wait, can't banks just create infinite money? No. And here's why. First, they need to make a profit. If they create a loan and the borrower doesn't pay it back, the bank loses money. So they only lend to people they think will repay. Second, regulations require banks to hold capital. This is basically a cushion of the bank's own money to absorb losses. The more they lend, the more capital they need. This is one of the tightest constraints in modern banking. Third, they need liquidity. Even though most money is digital, people still withdraw cash sometimes. Banks need reserves, actual cash or deposits at the central bank, to handle those withdrawals and settle payments with other banks. Let me clarify what reserves actually are, because this confuses people. Reserves are not the same as your deposit. Your deposit is a liability the bank owes you. Reserves are assets the bank holds, either as physical cash in their vault or as electronic balances at the central bank. Banks use reserves to settle payments with each other and to meet withdrawal requests. If a bank lends out too much and doesn't keep enough liquid reserves and suddenly a lot of people want their cash, the bank can't pay. That's called a liquidity crisis. And here's the terrifying part. Even a perfectly healthy bank can collapse if enough people panic at once. Imagine a rumor starts that your bank is in trouble. Maybe it's not even true, but people hear it and think, I should get my money out, just in case. A few people withdraw, then more. Then everyone rushes to withdraw at once. The bank has plenty of assets, loans, investments, property. But most of that isn't cash. It's tied up. They can't turn it into cash instantly, so they run out. Even though they're not actually bankrupt, they just can't pay everyone at the same time. This is called a maturity mismatch. They owe short-term money, your deposits, but hold long-term assets like loans and investments. And once a bank run starts, it can spread. People panic. They pull money from other banks. Healthy banks collapse just from fear. This happened constantly in the 1800s and early 1900s. Banks failed. People lost everything. The economy would seize up for months. So governments decided, we need to stop this. Two things changed everything. First, deposit insurance. In the US, this happened in 1933 after the Great Depression wiped out thousands of banks. The government created the FDIC, which guarantees you'll get your money back up to $250,000 per account, even if your bank fails. This alone stopped most bank runs. Why rush to withdraw if your money is guaranteed? Other countries adopted similar systems, and it worked. Bank runs became rare. Second, the lender of last resort. This is the role of central banks, like the Federal Reserve or the European Central Bank. If a bank runs out of cash during a panic, but it's not actually bankrupt, the central bank can lend it money temporarily to cover withdrawals. This keeps the bank alive long enough for the panic to pass. It's a safety valve, and it prevents one bank's problem from becoming everyone's problem. Now, this doesn't mean banks can do whatever they want. There are rules. Banks are required to hold capital to absorb losses. They're stress tested to make sure they could survive a crisis. They're monitored constantly. And in many modern systems, the tighter constraints are often these capital and liquidity rules rather than a fixed reserve ratio. Reserve requirements, where they still exist, are just one tool among many. If a bank is genuinely failing, not just facing a temporary panic, but actually losing money and making bad loans, regulators step in. They can take it over, shut it down, or force it to merge with a healthier bank. The system isn't perfect. Banks still fail. Crises still happened. 2008 proved that. But compared to the 1800s, when bank runs were a regular occurrence and entire economies would collapse every few years, the modern system is remarkably stable. Why? Because the system is built on trust, and the government backs that trust with guarantees. So, what does all this mean for how you think about money? First, money is a network of claims. Your bank balance isn't cash, it's a claim on the bank. That loan your neighbor took out, that's a promise to pay the bank. Money in a modern economy is just a web of obligations that we all trust will be honored. Second, trust is the foundation. Fractional reserve banking only works because most people don't panic. If everyone tried to get their cash at once, the system would collapse. Deposit insurance and central banks exist to maintain that trust. Third, stability has trade-offs. We have deposit insurance and lender of last resort systems because we decided bank failures were too damaging. But those systems create moral hazard. Banks know they'll be bailed out if things go wrong, which can make them take bigger risks. There's no perfect solution, just trade-offs. So the next time you check your bank balance, remember this. That number isn't money sitting in a vault. It's a claim backed by a bank, regulated by a government, and stabilized by a central bank. It's a system built on trust, held together by rules, and dependent on everyone believing it will work. And for the most part, it does. That's fractional reserve banking, not a conspiracy, not a vault, just a very old, very clever, very fragile network of promises that runs on collective belief. If you want to understand the world you're living in, not just repeat headlines, subscribe. I post one video every week, don't miss the next one. Because next week we're breaking down the science behind getting rich. No get rich quick side hustles, no hype, just a real deep dive into what the math actually says and why it's so hard for most people to stay in the equation long enough for it to work. And if you want the extra breakdowns, behind the scenes notes, and early access, the Patreon is linked below.